Hi friends, now in this session we will discuss the cash flow from operations in indirect method of cash flow statement. Now this is the area in this chapter where students face a lot of problem, and that's why I am separately providing this discussion. Now here in this video, my assumption is you understand the basics of cash flow statement, and after knowing the basics you are facing problem in this area only, because it is not practically possible for me to explain the direct method in detail, then indirect method in detail, and then discuss both the methods simultaneously. To simplify our discussion, we will mainly focus on the indirect method. I will start with the brief overview of the direct and the indirect method, but our main objective is to discuss these illustrations. So here I have 9 illustrations in total with increasing difficulty level, where you will be able to see how exactly the increase in receivable or decrease in receivable or increase in payable or decrease in payable reflects into the cash flow statement, so that you get the better understanding of the cash flow statement CFO part, indirect method, right? Let's start with the basic first, the quick overview. Now we know there are two methods: direct method and indirect method. Now, in both direct method and indirect method, we report cash flows in the format of CFO, CFI, CFF. Cash flow from investment, cash flow from financing, and cash flow from operations. If you consider the CFI part, cash flow from investment relates to the, mainly this is the cash outflow, and this relates to the investment in securities or investment in fixed asset. Okay. If you consider the CFI part, this part in statement, it is exactly same in direct and indirect method. Okay, so there is no change here, and this is also very easy. You get the ready information, like say $200 million spent on purchase of fixed assets. So this will come in the CFI part, cash flow from investment. When it comes to CFF, the cash flow from financing, this is also exactly same in both the methods. Again, the financing part relates to the issue of new shares, cash received in issue of new shares, or the bonds issued, or the loan taken. Okay, so all the financing activities are covered here. So this is mainly inflow and this is mainly outflow. Okay, and this is the reason why we are not going to focus on this part. Easy to understand, right? Now here, if you consider the CFO part, the cash flow from operations part, indirect method, this is very easy. Why easy? The reason is very simple. We take cash account and we derive all the value from the cash account and simply present the cash flow from operations. So this is how the direct method is treated. So you will get exactly like the cash receipt from the sales, payments made to employees, like that. Okay, so all the direct cash values are available here in the direct method. And that's why from the academic standpoint also, if you consider any exam from the academic standpoint, this particular method is not highly testable, because information must be given readily. Okay, and if you are provided with the information, working up with the or coming up with the CFO, the cash flow from the operations part, is not that difficult, right? So you can simply pull the values and get the answer. On the other hand, when it comes to the indirect method, in indirect method, to arrive at the cash flow from operations to CFO, we use net income. We make certain adjustments and then we get the CFO, cash flow from the operations. And the problem for students is like how these adjustments are treated. So in adjustments, we use balance sheet and income statement, and with the help of balance sheet and income statement, we arrive at the CFO. And as I said, this is not very intuitive to understand, and totally agree with it. And my objective here is to give you that intuition. When you will see all those illustrations, you will be able to understand how things move in balance sheet and income statement and ultimately impacts the cash flow statement. So it will improve your clarity substantially. You will never get confused in this area. I promise you that. So let's talk about this part, the CFO indirect method. Now in CFO indirect method, we have to deal with mainly 3 parts. So we start with the net income. In net income, the first adjustment relates to the non-operational and non-cash flow. So these are the adjustments related to the non-operational adjustments. So these are directly treated in the net income. So you take the net income, you add or remove or add or reduce, subtract the non-operational related items, and you add or remove non-cash flow related items. For example, we add back depreciation in net income to arrive at a CFO. So assuming like there is no other item in the whole income statement, your statement will look like net income plus depreciation is equal to CFO. I'm assuming there are no other items available. Okay, so everything is constant and just there is only one change in the whole process is the depreciation. So if you do this, you will arrive at a CFO. And why are we adding depreciation? Because in calculation, just see here, this is your income. Now just imagine for now, the whole income as in, so I'll just correct this. This is your revenue, not income. Okay. So this is the revenue completely earned or generated in cash. So 100% sale was in cash. So this is your cash inflow, right? CI, cash inflow. Now here, to generate this much revenue, we spent expenses excluding depreciation is say 100 million, and this is your cash outflow. Okay, so revenue 200 million, cash inflow, expenses 100 million, cash outflow, and say there is depreciation expense which is of non-cash nature is say 20 million. Okay, non-cash nature. Now if I take or if I calculate the net income here, this is 80 million, right? So you will subtract this, and you will finally get, so 200 minus 120 is 80 million. $80 million. This is your net income. Now if I roughly calculate the cash flow here, so I know this is my cash inflow 200 million and my cash outflow is 100 million. So my net inflow, net cash inflow is equal to 200 minus 100, and this will give me 100 million. Now here I have net income 80 million, net income 80 million. I know there is a depreciation in this. This net income got impacted by the depreciation, reduced by the depreciation. So net income, my net income got reduced by the depreciation, which is of the non-cash nature. So what I will do to arrive at the cash flow, I will simply add this non-cash expense in net income, and automatically I will get 100 million, which is this same. Okay, so that's why we add back the non-cash item here. And this is like, if your income is in non-cash, then you will reduce it. If your expense is in non-cash, you will add it. This is a very simple treatment. Then we have non-operational expenses or non-operational incomes. So we will make that adjustment as well. So say there is income, in net income, there is a component which was of non-operational nature. You sold fixed asset and you generated revenue or cash flow from that. Okay, so revenue from that. Now this will reflect in your net income. So we need to remove that part also. But this is because this is the non-operational nature, and whenever you are removing or adding or removing any non-operational nature item from the net income to arrive at a CFO, remember it will get reflected or it will get added or adjusted in either in CFF or in CFI. Okay, so it will show up in the cash flow from investment. We will see this, okay, in our like illustration number 9, I guess. This is the first part of adjustment, the cash flow, non-cash, non-operational and non-cash items. Second adjustment relates to the current assets, and then we have the current liabilities. Now instead of saying the current asset and current liability, these are the asset. In case of the assets exclude all the fixed assets, all the investment related assets. So in asset, you have to, in asset part, you have to remove or not consider all your cash accounts, not consider fixed asset accounts, and all the investment related. So whatever is going to show up in CFF and CFI. So in CFF and CFI, if something is going to show up in the CFF and CFI, then we will not consider it, and we will mainly consider the current type of, for example, the account receivables. then we have inventory. Okay, so all those things will be considered for the CFO part. Okay, and we will ignore all the other parts. If you consider, I'm just writing it as current asset, but remember the current asset excludes, in current asset we are excluding the cash account. In current liabilities here, these are the liabilities excluding all the like loans, equity, reserve and surplus and everything. Okay, so that part you exclude. Then you mainly have the say payable accounts. So mainly here we will have the payables. Combining both, this gives us the working capital scenario. Okay, but ignoring that part, so here just see, in current asset, remember the rules. Increase in asset increase in asset is reduced from net income. Remember, increase in asset, I'm saying asset, but these are current asset. I'm generally saying like the increase in, instead of asset we can say the increase in receivables or inventory. Okay, so increase in current asset, simply writing it as current asset. Increase in current asset will be reduced from inventory, net income, and decrease in current asset will be added in net income. So these are the two rules you have to remember. So asset is negatively correlated. The asset part is negatively correlated with the CFO part. Okay, in the CFO calculation. Okay, now see here. If you consider the liability part, so increase in liability is added in net income and decrease in liability is reduced from net income. So there is a direct relationship. Okay, so if we just consider the inverse and the direct relationship, so for the asset the relationship is opposite. So if you have increase in receivable, then simply you will reduce it from the net income. If you have decrease in receivables, you will add it in the net income. So this increase in asset part is known as utilization of cash. Utilization of cash or simply funds, and decrease in current asset is known as the source of cash or funds. On the other hand, when it comes to the liability, the increase in liability is the source of funds and decrease in liability is the utilization of funds. Okay, so increase in liability, source of funds, decrease in liability, utilization of funds. Simple. So if something is utilization of fund, it will have the cash outflow nature. If something is source of fund, then it will have the cash inflow nature, right? So once you understand this, you have to remember. So this much you have to remember for exam purpose, and then we will see our illustration. Okay. Now these illustrations starts with a very basic empty cash flow statement, and then we will gradually add item by item. Okay, so one item at a time, and then you will understand like how things work here. So we are first starting with the case number 1. So company started by funding $500 million in 21 and no business was conducted in 22. So in 21 no business, in 22 no business, in both the years no business. So here this is a balance sheet. Okay, so these are the figures. This is for 21, this is for 22. So this is the liability side and this is the asset side. Okay, so 21, 22. So 21, 22 for the asset, 21, 22 for the liability. This is the comparatives. Okay, on the other hand, in income statement we don't need any comparatives, so we can directly go with the 22 income statement only. Here we have the income statement. So because there is no business conducted, we have zero revenue, zero COGS or expenses. Ultimately in cash flow statement, net earning is zero. There are no cash flows or cash outflows or the inflows, and net cash flow will be zero here. Very simple to understand, right? But for next illustration, you have to remember these figures. So we started with the 500 million. In current year also, because of there is no business, we don't have any other item here. We started our business with the 500 million. That's why we have this 500 million in liability in equity part. Okay. And obviously, when the equity holder, the promoters of business provides 500 million, this will get deposited into the bank account, right? So that's why here we have this cash or bank account. Okay. And which is showing you 500 million. And our balance sheet is tallied 500 million here and 500 million here in both the years. Now let's go to the next illustration. Now here in year 22, we purchased inventory of 250 million in cash. We purchased inventory, this is year 22. We purchased inventory 250 million in cash. Now see here. This is for the previous year. Okay, so 500 million cash, inventory was 0 in the previous year in 21. And here equity is 500, so no change here. Now in 22, we utilized 250 million cash in purchase of inventory. So 250 million from 500 million utilized to purchase inventory. And finally, we will have 250 million worth inventory and 250 million worth cash. So this reduction in cash is coming from this purchase of inventory. And this is that's why we say this is the utilization of funds. Utilization of funds. Okay, now see. From this illustration, we know we have cash outflow of 250 million, right? In income part, there is no revenue and there is no COGS, the cost of goods sold, no expenses. Remember, the inventory, purchase of inventory is not the expense. Utilization of inventory is the expense. So when it comes to this cash flow statement, we'll start with the net earnings. Okay, so net income is 0. Now, we discussed for the items like the inventory, your receivables, all are these current assets, and these current, if there is an increase in current asset, we will reduce it from net income to arrive at a COGS, arrive at a CFO. Okay, not COGS. So what we will do here, increase in inventory, this is the asset, increase in inventory, you have to reduce it. What is the increase in inventory? From 0 to 250. So 250 increase, simply reduce 250. So you have, this is your CFO, net outflow, and then you have this total is your net outflow 250 million. And we know from the illustration, like our total outflow was 250 million cash, right? Simple. Next, sold inventory worth 100 million at cost. Now what are we doing here? So these values now we will consider as 2021 value, and then we will keep, or we will see the new adjustment for 2022. Okay, this will reflect in 21 in the coming illustration, in the case 3. Now let's see the case 3. In 21, we have cash bank or the cash balance worth 250 million, and then we have the inventory worth 250 million. Equity is same, 500 million. Our balance sheet for the 21 is tallied here. Okay. Now we sold inventory. We sold inventory at cost worth 100 million. So what will happen here? We sold inventory worth 100 million. So 250 minus 100, you sold that. Now you have inventory worth 150 million, and this will get added into the cash account. So 250 plus 100 million cash. So you will have the cash balance of 350. Now see, what is your total cash inflow or outflow here? So we have cash inflow of 100 million. And again, no business is conducted in this 2022. Now, no revenue, no expenses. So again, we are starting with the net income. Remember, we discussed decrease in asset or the current asset. Decrease in asset is the source of fund. Here, in inventory part, this is a decrease in asset from 250, 150, 100 million decrease. So this should be added in the net income. These are zero net income. and we will add our decrease in inventory, and this is our CFO. And finally the cash outflow is this 100 million. Very simple again, right? Just see this. We already know this, right? And we also got the same thing from the statement. Now we will go to the case number 4. Now here we have income part also. So from this part, okay, so just check the 21's figure. In 21 we have the cash 250 million, inventory 250 million, equity worth 500 million. Simple. When it comes to 2022, we utilized inventory worth 150. So there is no new purchase in inventory. We just utilized inventory from the existing inventory worth 150 million to sell the goods worth, or to generate the revenue of 250 million. Okay. So revenue generated in cash is 250 million. Cash inflow. In cash outflow, there is no cash outflow. Remember, we just utilized inventory. Now, from the inventory part, we utilize 150 from these 250. So 250 minus 150, you will get 100 million of inventories left here. Okay. No cash utilized. Now here, what I did, just to give you the better understanding, I kept the cash from business and cash normal separate. Okay, so generally you will not see cash accounts like this. It will be combined only, but just to give you the better idea, so I kept it separate. So cash from this business is reflecting this particular part. So you sold goods worth 250 million, and this is reflecting in cash flow, cash from the business. Okay, so 250 million cash. So we will have cash here, or this particular part is exactly same. So 250 here also. Inventory reduced because we utilize this inventory. And ultimately in this process of 250 million revenue minus 150 utilization of inventory will go into the COGS. We generated the net profit of 100 million. And this 100 million will increase your balance sheet size by 100. And you can see here, so from like your balance sheet size from 500 million, it is going to 600 million. Okay, in both the sides. This 100 million net profit will reflect in reserves. So these are your reserves. Equity is still the same. Okay, so ultimately this reserve will become the part of equity, but we are keeping it separate for now. Now, what is the cash outflow or inflow? We know 250 million. And now let's see how we will treat it. So we know the revenue of 250 million. Okay. Then COGS from the utilization of inventory. And this is our net income. Now for the first time, we have our net income, and we will treat the net income. So we have this net income, and we know we have to give adjustment for. Remember, the cash is not adjusted for CFO. Only the inventory part. So is this an increase or decrease in the inventory? So this is a decrease in inventory. So decrease in inventory, we will add it into the net income. Decrease in inventory of 150. Decrease of 150, right? So 250 minus 150, 100 million. Decrease in inventory of 150 should be added here. And you have your CFO and total cash outflow. This is your total 250. And what is, we already know this, right? So our total cash, this is inflow. Okay. So total cash inflow. This total cash inflow is 250. Fine. Next. Now here, utilized inventory worth 150, same as before. Goods sold 250, same as before, but out of which 100 million is in cash. Now see what happens here. We sold goods worth 250. So this is your revenue. Out of which 100 is in cash. This means our cash will increase by 100. So this is your cash from business 0. So cash from business is increasing from 0 to 100. And obviously this means 150 is receivable. These are our debtors. Okay, so debtor account we will create debtor account, and we will have accounts receivable of This means we have to receive 150 million from our debtors. So we have new account here, 150 million. Now again, the inventory utilization is exactly same. So you had the like 250 opening balance, you utilized 150 closing balance, meaning here we have 100 million inventory left. Fine. Now see here. What is cash inflow here? So 100 million cash, right? But income is 250 minus 150. 100 million is the income. Now let's see. Income statement. Revenue 250. COGS 150. Net income is 100 million. Now let's see the adjustment. So first adjustment in the net income part, the cash flow part is, we'll start with this, the net income. Decrease in inventory, 250 minus 100. You have to add it. Increase in account receivable. This is your current asset. Increase in account receivable. You have to reduce it. Reduce it. Okay. So now 100, 150 minus 150, total CFO. Okay. Cash flow from operations. This is cash inflow. And net cash inflow is 100 million. So we already know this. Our net cash inflow is 100 millions. Right. Next. No revenue generated but received cash 100 million from debtors. So now these figures are going into 21 in our next illustration, and then we will see the development. So see here, cash account 250 million, inventory 100 million, cash from business, again you have to, like, this is the same thing only. So cash and cash from business is the one and the same thing, just showing it separately for your understanding. 100 million and account receivable 150 million. This is your liability part. So the equity and reserve 100 and 500 and 100. Now no business, no revenue generated. So no business was conducted in this year also, 2022. But what happened? Previously we had opening balance for debtors of 150, out of which cash received is 100. So they owed us, our debtors owed us. We had the receivable of 150, out of which 100 million we got paid, and now we have remaining account receivable of 50 million. So we have 100. So 100 received in cash. So our cash will increase. Our cash will increase. Just see this, cash increased from 100 to 200, and closing is 50. This is your closing of 50. Simple. No business conducted in this particular part. So only two changes here. The first change is here, second change is here. Rest of the part is same. Again, no revenue, no COGS, no income. We are starting with the no income. Remember, increase in asset to be reduced from net income to arrive at the CFO. Decrease in asset should be added into the net income to arrive at a CFO. Decrease in account receivable, simply add it in the net income. This time our net income is 0. I'm intentionally keeping net income 0 so that you get the intuition of these receivables payables part. Okay, so 100 added, and your cash flow, CFO, cash flow from operations, is 100 only. Cash inflow is 100 only. Okay, so this is clearly seen. You can see here 100 million cash received, right? Very simple. Next. Now here we are increasing the difficulty level of the illustration. From 7 onwards, our illustrations are slightly difficult. Let's see. Purchased inventory worth 150, out of which 50 is purchased in cash. Okay, so we purchased inventory worth 150, but we purchased only 50 in cash. Rest 100 million is in credit. Okay, so if you are purchasing on credit, you will have the liability of 100 million. And this is our, like, in 21 we have no liability. In 22, we purchased inventory in on credit, 100 million worth credit, 100 million worth inventory on credit. So this is showing in the liability part. Okay, so this is accounts payable. Now, we purchased inventory worth 150. So obviously here our inventory will increase by 150. Next, inventory utilized in production, $200 million minus 200 million utilized in production. Revenue generated is 300 million, and this is 300 million, out of which like you have 100 in cash, okay, and rest of the rest 200 million is in the credit. Now let's see this one by one. So first, cash account, we are seeing the reduction, okay, so from 250 to 200. So the 50 here is utilized in purchase of inventory, remember, okay. So from 250 to 200, the 50 minus is coming from the purchase of your inventory. Next is inventory part. I will give you the explanation of the inventory part. Then we have the cash from the business. So revenue generated 300, okay, out of which 100 was in cash. So 100 is in cash. So your cash from business will increase by 100. So from 100 to 200, okay. So this is simply the plus 100 from the business. This is minus 50 to purchase inventory. Here we know sale of 300, out of which 100 is in cash. So 200 is new accounts receivable. New accounts receivable. So previously we had 150 accounts receivable, 200 new accounts receivable. This will give us 350 accounts receivable. Okay, 350 in debtors account. Fine. Now the inventory part. Opening balance of inventory is 100 plus new purchase, or simply the purchase of 150 minus utilization of 200. If you solve this, 100 plus 150 is 250 minus 200 is 50. So your closing balance of inventory is 50, and this is showing in the inventory account, right? So we have inventory left is simply 50. Got it? Now see, I'll just remove this. Again, as usual, we have to answer our first question. What is our cash flow here? So here cash inflow is 100, okay, this, and cash outflow is 50. If you solve this, you will get 50 cash inflow. This is our revenue statement. So income statement. So revenue 300 million, COGS, inventory utilized, and finally you will have the net income of 100 million. Now the cash flow statement. So we know the net income of 100 million. First adjustment, decrease in inventory. Assets are reducing, decrease in inventory. We have to add it into, this is our source of fund. We have to add it into our net income to arrive at a CFO. We are adding it. So what is the decrease? Total decrease 100 to 50. So total decrease is 50 only. Add it. Then increase in receivables from 150 to 350. You have to reduce 200 million. So increase in receivable will be reduced, decrease in receivable will be added. So, or decrease in inventory will be added. So decrease in inventory we are adding, and increase in receivable we are reducing, because this is a utilization of funds. Now payables from 0 to 100, and remember, increasing payable is a source of fund. That's why we will add it. Decrease in payable is utilization of fund. So we will reduce it. So here we have the increase in payable. So we will add it. If you solve this, so net income plus 50, you have 150 minus 200, then plus 100, answer is 50. Cash inflow, CFO. of 50. What was our answer? 50, right? So CFO of 50, we already know this from our illustration, but in exam you won't get provided, like you will never get this particular part. Okay, so the mainly you'll be provided with the balance sheet, so you have to look for the change in the balance sheet and then simply take the income statement. So you have to work on CFO or in indirect method using this only, so balance sheet and the income statement only, right? So we know 50 is our cash inflow, and here even in the cash flow statement we are seeing the 50 is our cash inflow. Now next illustration. Purchase inventory worth 150, out of which 50 is cash purchase. Purchased inventory worth 150, 15 cash purchased, utilization of 200, revenue generated 300, out of which 100 is in cash. Now this whole portion is exactly same as before. The only new treatment here is purchase of plant and machinery worth 200 million and depreciation is charged here worth 50 million. Okay, so we purchased plant and machinery 200 million in cash, so the cash will reduce by 200 million and depreciation charged is 50 million, so we will have additional expense here. Now let's see, there is correction here. Okay, so first, cash or bank account opening balance was 250. We purchased inventory by paying cash, 50 reduced. We purchased plant and machinery by paying 200 million, 200 reduced. So finally you have 0 here. Okay, you have cash from the business, but your normal account is 0. Now next, inventory from 100 to 50, same as before. Accounts receivable from 150 to 350, same as before. Your reserves are increasing here. Okay, then you have this equity part same, and your payable is 100. Okay, from 0 to 100, same as before. Now let's see the plant and machinery part. So we purchased plant and machinery worth 200 million and accumulated depreciation. Here we are using it as accumulated depreciation. Instead of showing it in the net, we use the accumulated depreciation. And finally, the net plant and machinery is 150 million, right? So let's see here. Remember, you will treat this accumulated depreciation part as like the proper from the income statement, not from here. You have to remember this. So let's see. First, the revenue, cost of goods sold. Now we have new entry, depreciation, total expense 250, net income is 50. What is our cash flow? So our cash flow is, we paid 50 for the purchase of inventory. We received 100 from revenue. We paid 200 to purchase asset. Net is 200, 250 plus 100 minus 150. Okay, minus 150. So these are cash outflow of 150. Now let's see how to arrive at a cash outflow of 150 using the indirect method. Now we'll start with the net earning. Now first, non-cash adjustment. Non-cash adjustment. This is the depreciation. You have to always look for the depreciation. If you see the depreciation, don't think anything, like simply add it back into the net income. So we are adding it. Simple. Decrease in inventory, same as before. Increase in receivables, same as before. Increase in accounts payable, I guess same as before, right? So these are the treatments. So here, increase receivable is reduced, decrease inventory is added back, increase in payable is added back. Okay, so are added. And you have, this is your CFO. Cash flow from operations is 50 only, remember. Now, here, fixed asset purchased worth 200 million. So cash outflow in investment. Okay, so CFI part. In CFI part, we have 200 outflow. And if you take the total, so 250. So finally you have 150 cash outflow. This is our cash outflow. Net cash outflow. If we just consider this particular part, the operations part, so this is our plus 50. So our CFO, just from looking here, So sale and COGS part, right? So if you just consider this, your CFO is plus 50 cash inflow, and this is your cash inflow 50, right? So plus 50 and net is minus 150. So again, we are able to match this cash flow using simply the cash flow statement. Last part, same, everything is same here. This is also same. The only treatment we have, or only information, new information in this illustration, is the company issued bonds worth 300 million. So this is worth 300 million. So if you just consider the total cash, because this is a purchase of bond, so company issue, sorry, not purchase of bond. So this is the issue of bond. Obviously, you will get a cash inflow of 300 million. So if you just take the cash inflows and outflows, so you have this first cash inflow, then cash outflow for the plant and machinery, cash inflow from revenue, cash outflow. Okay, so if you take the total, this is 300, 100, 100, 100, 0. Just a second. This is 400 minus 250. So finally, you will have 150 inflow. Okay, 150 inflow. So let's see now. Cash flow statement. So we'll start with the net income. Add back depreciation, decrease in inventory added, increase in receivable reduced, increase in payable added. Cash flow from operations 50. Fixed asset purchase minus 200. Okay, utilization of cash, and financing. Okay, so plus cash flow from financing. So bonds, equity, new shares issued, new bonds issued, new loan taken, all will reflect in the CFF part, cash flow from financing part. So you will have here plus 300. So if you take the total cash flow is 150 only, right? So very simple here. So this is our cash inflow, net cash or total cash inflow. And again, our total cash inflow is 150 only. So this is how we match or we work with this CFO part. So if you have any confusion, you can ask me in the comment section. One more thing, we have the treatment of this. So prepaid expense, accrued liability, and deferred tax asset, the DTL and DTA. Now first, I'll just give you the quick idea. Prepaid expenses are our receivables. We pay expense in advance. So these are our asset. So you will treat it like the current asset only. So increase in prepaid expense will be reduced from net income, decrease in prepaid expense will be added into the net income. Accrued liabilities. So these are our liabilities, you will treat it like a liability. Then deferred income tax. Now in deferred income tax, we have two parts. So DTA and DTL, deferred tax asset and deferred tax liability. Right now I'm not discussing what is a DTA and DTL. So we will discuss this in the income tax chapter. So here DTL and DTA will be treated accordingly. So if you have DTA asset, so you will treat it like an asset. So if you have DTL, so deferred tax liability, you will treat it like a liability. Okay. So this is very short discussion on the cash flow statement. So thank you everyone. Thank you for watching this video. If you have any queries, you can always WhatsApp me on my number and or like simply comment in the comment section. I will help you out, right? So thank you everyone. Thank you for watching this video. See you in the next video. Bye bye. Take care.